record this for all the guys who can't make it. Okay, guys know Anele, the name from Amplified Trading. So this is our very first session for the beginners, right? So if obviously when you're a beginner, you're starting off with this material, so you have to be in, I can say, tune with all of this and understand this. And I know a lot of guys like to take the refresher. However, if you feel like the material is not directed for you or is not at your level of understanding, then you are most welcome to join in the more advanced classes. Okay, right. So the advanced class, I think, is going to be somewhere around 8:30. So we'll probably have about 30 minutes for us to actually get through the PDF, and everyone will get a copy of the PDF. So just either drop me your email address, or I can send it through to you via WhatsApp if you have something to transfer it onto your laptop so you can read it. Okay. Now, basically, what FX market is, right? Foreign exchange market, is the largest and most liquid financial market in the world, right? So there is, at this present moment, I think about 5.6 trillion US dollars being traded there daily, which means that amount of money actually exchanges hands, right? So there's a lot of different market participants within the foreign exchange market, and therefore, I mean, the market will move on a day-to-day basis, on a second-by-second basis, on a millisecond basis. So there's always fluctuations with the price. Fluctuations meaning like changes in price, and therefore it offers us a lot of opportunities to actually earn some money. Right now, currencies are what traded in the foreign exchange market, or shortened FX market. Okay. Now, you buy if a currency, for example, if you feel that it is gaining strength and it's actually appreciating, and you'll sell it if you feel that it is becoming weak and depreciating. Okay, so if you feel like the market will drop, then you'll go short, and if you feel like the market will rise, then you'll buy, you'll go long. The currencies are always quoted in pairs, because whenever you want to know the value of a currency, it has to actually be compared with something else. So you can't compare it with itself. So in relation to that, you always compare, let's say, the US dollar to the South African rand, for example, which forms the USD ZAR. And the reason we do have different currencies, an exchange of currencies, is because when you're traveling to the US, right, you can't go there and spend South African rands, right? So they accept United States dollar. That's the currency that they actually use, and therefore that particular currency will be the one that they do prefer to exchange with. Whether you want to go buy a hot dog, you want to go buy CDs, you want to buy a pair of sneakers, they will prefer payment in United States dollars. Okay, now when it comes to the market, right, so you have a huge market, right? This very large market, and it has, as I mentioned, different market participants, right? So the structure is a very basic and simple one. We do have a large majority of professional money, which is within the market. So I would say about 95% of the liquidity within the market is controlled by professional money. Okay, so professional money meaning your liquidity providers, your market makers, your brokers, your hedge funds. So I will also break it down into two sections, right? So there's two sections of professional money, right? So we're going to be looking at, we've got your smart money, and we've got your dumb money, and then we've got your retail trading money, which is usually super dumb money. And what we're trying to do is, obviously as a retail trader, is you're trying to go where all the big money is. Okay, so about 80, roughly, on estimate, percent of the foreign exchange market is on a day-to-day basis controlled or influenced by your commercial interests. We're talking your large banks, your investment banks, for example, Barclays, right, Deutsche Bank, Citigroup, those guys. So if you're looking at foreign exchange, so if you go and type in Forex, you'll see a percentage in Wikipedia of the actual percentage that each and every single one of the top 12 banks in the world actually controls of the market. Okay, so they actually have that information up there. And yeah, what they do is they provide liquidity, okay, for retail traders. They provide liquidity for professionals, right, which is your hedge funds, which can be broken down to about, I can say about roughly on estimate, okay, about 15 to 20%, right? Somewhere between there. And obviously the large investment, the large big money is about 80% of the liquidity, right? Liquidity simply meaning the money. Okay, don't let that term confuse you. Okay, now the FX market is basically a 24-hour market which opens Sunday and closes Friday again. Okay, now the time, there is a 1 hour difference, okay, which is influenced by daylight savings. Okay, so I'll let you guys do a bit of research on that. Just research when daylight saving time actually starts, right? I was going to give you a clue, but I won't. But it's sometime during our winter, and when it actually ends. Right. So daylight savings time is when the US basically decides that everyone else as well should set their times back either 1 hour in front or 1 hour behind. Okay, so they basically decided that for everyone, and therefore we usually follow that particular procedure. Okay, now in terms of sessions, right? So if you are brand new to trading, there are 3 main sessions. We won't go into too much detail about what goes on in those sessions. However, there is the Asian, the London, as well as the New York session. Okay, now this is the Asian session is usually the one that's quiet. Okay, aside from some Asian markets, simply because there is your London as well as in New York, right? So New York being the main area, okay, I can say area or city where there is the most amount of trading, right? So we're talking Wall Street. That's where Wall Street is. That's where all the big investment banks are. So because there's different time zones, right? New York people are, I can say, usually sleeping, I'm guessing, when the Asian session kicks in. So therefore, the New York banks and all of that stuff are not trading at that particular time, right? So likewise, London session, people are probably looking to get up, right? Alarms are just going to click through, and therefore, the guys in Asia are by themselves, aside from those 1 or 2 retail traders who watch the markets 24 hours a day, and therefore the Asian session will usually have a lot of liquidity or will have a lot of movement within the Asian currencies. Okay, so we're talking the Japanese yen, the Australian dollar, the New Zealand dollar. Okay, and the London session also, a lot of the European currencies will be moving during that time. We're talking the euro, we're talking your, how's I supposed to say, German thing. I'm not sure why I have the Bundes. Is it the Bundes? I can't quite remember. The Swiss franc, your Great British pound, right? The Swedish krona. Those are the markets that will generally move around the London session, because in Europe they're up, they're busy, right? They're trading, and then during the New York session, then we have the US markets come alive, right? So even the stock exchanges actually open up during those times, right? So that increases the trading volume for that particular session. Okay. Now, the brokers are firms that provide foreign exchange currency traders access to the market through a trading platform, right? It's called MetaTrader 4 generally, right? There's different platforms that are out there, but generally traders will go with MT4, and there's a newer updated version which is called MetaTrader 5, which is not catching on as it should, but I mean it has some really nice features. But the broker then pays for these platforms and to have its signage on these platforms, and what they do is they provide access. They are the middle man or middle woman, or whatever you want to refer them to as, and they basically do on a day-to-day basis. They help with the execution of trades, right? So there are different types of brokerage, right? And depending on what type you pick, it could affect the trading and the way you actually your equity curve is, right? So whether you end up making money or you end up losing money, it will all depend. It could, okay, it could be a factor, right? Because obviously your skill level and all these other aspects will definitely come into play, but it could influence whether you do make money, especially if you're a new trader. Right now, brokers are broken up into, let's say, market maker brokers, right? Or dealing desk brokers, DD, or non-dealing desk, or ECN brokers. Right? So ECN brokers, ECN stands for Electronic Communication Network, which is a basic, um, which is a fancy way of saying the broker just takes your order and it is automatically routed through to the live market. Okay, so they don't interfere with your trades. But with a dealing desk type broker, what could happen is that you could be executing your trades, and the broker could be taking the other side of your trade, and therefore that means you and the broker are in conflict of interest, and if you make money, he loses money, and therefore it's in his best interest to make sure that you do lose money. Yeah, so we'll touch on a bit about that in the later stages, but for now just know that broker, there's lots of different retail trading brokers out there. There's a couple of local ones, but one of the main things that you need to look for when it comes to um, a foreign exchange broker is obviously regulation. There are regulatory boards that govern how brokers conduct themselves, and if a broker can actually choose whether they do want to be regulated by that particular board of that jurisdiction. Right? So here in South Africa, we have the FSCA, previously known as the FSB, which is for Financial Services Board, and they are, in fact, one of the strictest boards. I mean, they're pretty well run, and what they do is they just oversee and look what these regulatory brokers do on a day-to-day basis. Good. Now, currencies and currency pairs. Currency basically means money, so a currency of a country is the money used in that particular country. So, won't make any examples of that because they're actually quite self-explanatory. Now, there are major currencies in the world which belong to the more developed countries, and the minor currencies are the ones that belong to the smaller, developing second, third world countries. Okay, now, currencies are quoted in pairs. For example, USD ZAR, right? So the first two letters, okay, of this abbreviation of USD, okay, abbreviation here, USD. First two letters represent the country, and then the third letter represents the currency. So US, United States, and the D stands for dollar. And then the ZAR is ZA, South Africa, which is obviously Afrikaans, Zuid Africa, and R is for Rand. Okay, now the one on the left is called the base, the one on the left, and the one on the right is called the quote or the counter. Okay, now the base currency is the main one that we're going to be buying or selling, and the counter, you do the exact opposite of what you do to the base. So if you say I'm buying USD ZAR, that means you are buying the US dollar and you are selling the South African rand. Okay. All right, guys. All right, so the relationship between the base and the quote is important in helping to us to figure out the actual spread. Okay, so the spread is the currencies pair are always quoted in two different prices, the bid and the ask. Now, if it's, how can I put this? Now, the bid and the ask price are basically the two prices at which the broker, okay, because all these liquidity providers are providing you with prices, right? They're saying, okay, I can buy the USD ZAR from you at 14 Rand 20. This other one will say, no, I'll buy from you at 14 Rand 16. So the broker will either take the best price of the two, okay, and give you the lowest spread, or take whichever one he wants, just randomly pick and then give you a much wider spread, and on top of that, add on his sort of like spread. But spread is really just if you went into a bank and you wanted the USD which is the United States dollar, and you brought in 14 Rand, and they told you that we are only willing to sell to you $1 for 14 Rand 10 cents, and you add 10 cents to that 14 Rand, that is them giving you a price at which they are willing to sell to you. Okay. So when they bid, it is the price that they are willing to buy from you. So what would basically happen if you came back with that same 14 Rand 10 cent and or with that $1 that you took with you, and you went back to the bank and said, here is your $1, I did not use it, I would like to get my 14 Rand 10 cent back, and they would say, no, we will only give you 13 Rand 90 cents, even though the exchange rate is 14 Rand, but we are willing to buy it back from you for 13 Rand 90 cents. Okay, it's basically what they say. They're incurring the risk of the currency either dropping significantly or rising significantly, so they deserve to get the spread. Okay, so yeah, the difference between those two prices is actually the spread, and you'll see it on the platform. So once you go through the trading platform videos, you'll see what the spread looks like, and you'll see the bid price and you'll see the ask price before you take the actual trade. Okay, now long simply means buying, and short simply means selling. Okay, going long or going short same means going buying, and going short means selling. Okay, so you're selling the market. Right now, major currencies, okay, included is the USD, sir. I mean the South African rand. Obviously, that's not a major one, but we like to think it is. The United States dollar, those are the major currencies of the world, right? Talking the world. The United States dollar, the pound, the euro, the New Zealand dollar, Australian dollar, and the Canadian dollar, right? So those, and the Japanese yen is also one of the leading major currencies that we actually have, because they belong to very strong economies. Currencies are represented in symbols, right? I did already mention that. First two letters represent the country, and the last letter of the abbreviation represents the currency itself. Now, a pip and pipette, right? Let's ignore pipette for now. Now, the pip is the fourth number after the decimal. So, if you're looking at the price, right? So if you're looking at the price is going to be quoted like this. So, if a currency the price of a currency is 1.25487. Okay. Now the fourth digit is the actual pip, right? And okay. So the letter, the number 8 is where the pip ends, right? And the number 7. Sure, why I'm keep saying letter, right? And the number 7 is actually a pipette. Now we ignore the pipette, not counting pipette, because the pip is like a second, and the pipette is like a millisecond. Okay. Now, as I mentioned, prices are usually quoted in 4 decimal places. So let's use an example of the South African rand and the United States dollar, right? Okay. So this is 14 Rand. Okay, so $1 costs 14 South African rands. So for us to see that on the MT4 platform, right? On our MT4 platform, this is how it would be shown. Okay, hopefully you guys can see my squiggly handwriting. Okay, so that is how 14 Rand actually looks on your MT4 platform. All right, that's good. So 1, 2, 3, 4. So this is the pip. So if this moves from 14,000 to 14,002, that means the market moved up 2 pips. Okay. And if it moves 14,000 to 14,000, let me just move this to 20. Okay, 14,020. That means market has moved up 20 pips. Okay, right. I'm hoping everyone actually has a really good idea about that and understands it. Pretty straightforward stuff. Okay, not sure what the racket is outside, guys. Apologies about that. Now the leverage is loan that your broker gives to you, so you can actually take bigger positions within the market. So, for example, if you go out and choose a leverage of 1:100, okay, that means for every single dollar that you have in your account, the broker will give you 100 US dollars. Okay, so if let's say now this loan that the broker provides to you is you don't have to pay it back. Okay, they just allow you to use it to generate more profits, and you actually get to keep the profits. Okay, so when you choose your leverage, let's say you choose 1:100 leverage. So that means every dollar that you have in your account, the broker will give you $100. Okay, so let's do this then. If you have $100 in your account and you use a leverage of 1:100, that simply means you have $100 times 100, which is 10,000 US dollars to actually trade with. Okay, now you cannot withdraw this money. Okay, you can only withdraw the profits you make with this 10,000 US dollars. Okay, when you're looking at your account, you're only going to see the $100, but in actual fact, you're going to have 10,000 US dollars, which is why you can place multiple trades, because one unit, okay, if you buy €1 USD, you are buying actually 1,000 euros. Okay, that's the smallest contract you can go. That is 1,000 units. So if you have a leverage of 1:100 and you have $100 account, technically you can buy 10 contracts. Micros. Okay, so micro is basically the smallest increment that you can actually have when it comes to the market. Okay, so if you can buy, if you have $100 trading account, and you're using a leverage of 1:100, then you have about 10,000 US dollars. You can trade 10 micros, 10 0.01. Okay, you'll be balling all day, balling all summer with that. Okay. All right, so now margin. All right, now margin refers to the minimum amount of money that the broker requires you to maintain in your account. It's sort of like in your bank accounts. There's a minimum amount, so the broker will have a margin stop out level. Let's say 20%, which means if your losses exceed, go below, let's say 20% of what you had in your account. So let's say you had 1,000 US dollars in your account and your losses are at 800 US dollars. That's like 80%. So you're losing 80% of your account. That means once it gets to 200 US dollars, the broker will then close all the positions that you actually have on your account. Okay, because you're losing 80% and you're supposed to maintain a 20% account balance. Okay. So the margin call refers to a situation where your current losses, until the loss amount of all of them put together, let's say you have multiple trades running. One is $20, another 20, another 100. So it's not just one trade, but all of them total that 800 US dollars. As soon as it goes, for example, to 801, then the broker could basically close your position. Now, different brokers have different automatic stop out levels, and that's something that you'd have to query with them or when you're actually opening up an account. Okay. Now, orders used, there are 5 different types of orders, but we only look at 2, which is basically the market order, which is an order that you place right there and then. So you look at the market and you believe that the market is going to go up or it's going to go down. So you use what's called the market execution. You buy and sell at the available price. Okay, instant execution rather. Okay. Now, a pending order is a different type of order which is used if, for example, you believe that the market will rise to a certain level or drop to a certain level, and that is the price you're willing to buy it. So, for example, if you believe that the USD is right now at 14 Rand, and you believe it's going to go to 15 Rand, and from 15 Rand it's going to drop to 12 Rand against the dollar, then you put a pending order to sell once it gets to 15 Rand, okay, and buy back your position at 12 Rand once it drops down to 12 Rand. So you'll close your trade basically. Okay. So that is the basics of the order. The types of pending orders you can use, the limit as well as the stop. Okay. A limit is used if you believe that the market is going to do this, right? So a limit order, if you believe that the market is going to go up and then drop from there, you would use a sell limit. Okay. All right. And then if the market is going to move higher, you'd use a buy stop. Okay, I can't write this. So let's just pretend that this is buy stop and this is sell limit. Okay, here again, you would use a buy limit if you felt like the market was going to drop down and go up. So you'd use a buy limit there, and you'd use a sell stop if you felt like the market was going to drop down and break through that previous structure. So once you get into the nitty-gritty of the market, okay, if you're looking at how the market behaves, right, there's going to be breakouts and there's going to be reversals. So you'll be using the two different pending orders for those two different types of scenarios. Okay. The stop loss, a stop loss is, I believe, is the most important order, because what it does, it's important because it protects you from unnecessary losses. Now, stop loss is a point where the broker gets you out. So let's say, for example, you're working with a car dealership and they're selling your car is valued at 100,000 Rand, and if the value of the car drops to 95,000 Rand, they should automatically sell it off. Okay, so that's essentially how a stop loss order would actually work, to protect you or the asset that you actually have from it going, let's say, from that 95,000 to 45,000, so if it's losing value too much, or too quickly rather, then you'd want to get out of the market, and it allows you to specifically allocate a certain amount of risk to each and every single trade, because trading without a stop loss means that you're exposing 100% of your account, but trading with the stop loss means that you can basically set a limit on the amount of pips that you can lose, and also the amount of US dollars you can actually lose in one particular trade. Okay, now the trading stop order, primarily to protect your money from losses. Let's say if a trading stop loss would help you to trail a market where, let's say, it's going in your direction, right? So the market is moving slowly towards whatever intended direction that you pick. Let's say you said the market is going to go up, so you would take that stop loss and you'd actually start moving your stop loss. Let's say this was your entry, let's say this was your buy, right? So this was your buy, let's put a B just to avoid any confusion, and the market is moving up in your direction. Okay, now a trailing stop is an automatic stop which you can place on your platform as long as your MT4 is open. So it's much easier if you're doing it on a VPS, but you can do it under any normal circumstances. And then the market or the broker will automatically move your stop loss in a certain amount of pips in terms of distance from the actual price. So if the price is here and you set your stop loss to be, your trailing stop rather, to 20 pips, If it moves up 10 pips, this will also move up 10 pips, but it'll keep that 20 pip gap. But if the market then moves down, it won't move down as well. It's just going to stay where it is. Okay. So the trading stop will stay where it is. So if you bought here and the market rises in your direction about, let's say, 80 pips and then pulls back 20 pips, then it hits your stop loss, that trading stop loss. That means at least you got this amount of profit there. So the stop loss, trading stop rather, is effective, especially so if you want to book some profits along the way. Okay. Now, there's essentially two types of market analysis. Market analysis is how you look at the market, okay? So how you analyze the market and come to a conclusion. Now, there's two main ways to do that. You can do that from a technical standpoint by looking at charts, patterns, oscillators, anything that is on your MT4. Okay, that would be described as technical analysis. And then you have your fundamental analysis. Now, fundamental analysis is looking at the news, right? Looking at the economy, looking at the non-tangibles, okay? Like what the geopolitical events are and all of that stuff. So you look at all of that, then from there make a trading decision whether the rand is going to decline or it's going to rise. Okay, so now factors that do influence let's say a currency would be interest rates, obviously, unemployment, GDP numbers, the money supply, social as well as political forces. They always play a role, obviously, in any sort of logical economy. Now, it's therefore you have to be in tune with that if you are going to be a fundamentally based trader, okay? Because there's fundamentally based and then there's technical based. And sentimental analysis is basically a focus on people's emotions, right? So you feel like you love South Africa so much that you only want to be buying the US dollar, the South African rand. Okay, so that would be sentiment. Now, the platform refers to the software that you download. Now, you download this on whether your smartphone or your laptop, and use to place trades. It's known as MetaTrader 4, as I mentioned, developed by MetaQuotes, and you'll find different tools there to use to analyze, and that is strictly for technical analysis, right? And then fundamental analysis, we'll be using something like my FX book, or what is this? Another one. Not sure where my mind is today, but there's different sort of like places, like even Bloomberg, stuff you can look at, economic calendar, FX Street, yeah, that's the one I use, FX Street, and you'll be able to see everything from it. Right, so just check out the module 1, the webinar series for the demonstration on how to actually download and set up MetaTrader on your device. What I'll do, I'll send you through the link. Just send me a text, WhatsApp, right? Boom, send me a text on WhatsApp, and then I'll send you through that video for you to be able to download the MT4 platform so you can actually get started, right? So do you guys have any questions? I think we have about 4 minutes left. Then I'll have to start with the advanced guys. So any questions? Okay, no questions, guys? Okay, so if there are no questions, what I'll do, I'll upload this, right? Probably after the advanced session, I'll upload this so everyone can get a view, right? So I can check this out later on, right? So yeah, guys, I'll see you guys. The next session you can actually attend. The next session is going to be tomorrow. Tomorrow is Thursday, right? Yeah, I think tomorrow you can start attending some of the more intermediate stuff. And if you want a recording of this, you'll find it, the link in the group, and I'll send you through the PDF as well. Just send me a text with all of that, guys, so I can send it through to you. All right. Hope you guys enjoyed this session, and I'll see you guys later. Cheers. Yes, you can set a stop loss and a pending order at the same time. Books. Um, I do have a few PDFs. In terms of books, I mean, the only books that I have are audio books, right? Because I have an account with Audible, so I just buy audio books from there. All right. But once you watch the video, I think it's the day 5 video. It shows you how to set the pending order as well as the stop losses. Okay. All right. Cheers, guys.